If you're new to the stock market, it's important to understand that when you buy a stock, you're essentially purchasing a small portion of a company and becoming a partial owner. The idea behind investing in stocks is to acquire shares of companies that you believe will increase in value over time. By doing so, you can potentially multiply your investment without having to put in additional effort. However, for many people, the stock market can seem overwhelming and confusing, leading them to make impulsive decisions when selecting the companies to invest in. To attempt to predict stock market behavior, there are two main approaches: technical analysis and fundamental analysis. Technical analysis is often employed by short-term day traders who focus primarily on studying charts and patterns. They believe that by analyzing the highs and lows on graphs, they can predict how stock prices will change. The goal is to keep the investment strategy simple and straightforward. On the other hand, fundamental analysis is a preferred approach for long-term investors. It involves delving into the fundamentals of a company, such as its financials, leadership, and brand recognition. Long-term investors believe that these factors are indicative of a company's potential for long-term success. While fundamental analysis is their primary focus, they might still keep an eye on charts occasionally to identify optimal buying opportunities. This balanced approach has enabled long-term investors to make sound investment decisions and find profitable investments over time, instead of constantly buying and selling in an attempt to make daily profits. It's interesting to note that the majority of professional traders struggle to consistently outperform low-cost index funds. This is why many investors allocate a significant portion of their investments to index funds, which are designed to track the performance of a specific market index, such as the S&P 500. By investing in index funds, an investor's money is spread across a diversified portfolio of companies. The diversification helps reduce risk, as the performance of one company does not have a significant impact on the overall investment. Additionally, investors might allocate a portion of their portfolio to individual stocks, where they can exercise their own judgment and potentially find high-growth opportunities. When it comes to choosing stocks for investment, it's essential to consider both quantitative and qualitative factors. Quantitative analysis involves examining financial figures related to a company's balance sheet, income statement, and statement of cash flow. The balance sheet provides insights into a company's assets and liabilities. Assets can be categorized as current assets, which can be converted to cash within a year, long-term assets, such as property and equipment, and intangible assets, such as brand recognition. Liabilities, particularly current liabilities, represent the debts companies must repay within a year. Evaluating the relationship between current assets and current liabilities can help assess a company's ability to manage short-term debt. A ratio above 1 is generally considered favorable. The income statement reveals a company's total revenue and net income. Total revenue represents the amount of money the business earns, while net income is the money left after deducting expenses. Operating income, obtained by subtracting operating expenses and revenue costs from total revenue, provides an indication of a company's profitability. Investors often calculate the operating income as a percentage of total revenue to assess the company's health. A higher percentage, typically above 15%, is considered favorable. The statement of cash flow focuses on the company's cash inflows and outflows. Investors primarily look for consistent growth in free cash flow, which represents the money available for reinvestment or distribution to investors. A negative cash flow combined with dividend payments can be a red flag, as it indicates an unsustainable situation where the company may run out of cash. In addition to quantitative analysis, qualitative analysis plays a vital role in stock selection. Factors such as brand recognition and consumer trust are crucial indicators of a company's potential success. Strong brands often enjoy higher consumer loyalty and have an easier time launching new products or entering new markets. Monitoring news and social media rumors is also important, as they can significantly influence stock prices. However, it's important to avoid getting caught up in hype-driven investments, as they often lead to unsustainable price increases. Successful investors pay attention to company leadership and their ability to shape the company's future. Leaders who have a clear vision and can effectively communicate it to the public can positively impact stock prices. Predicting the best time to buy stocks is challenging, and it's nearly impossible to time the market perfectly. However, a strategy called dollar-cost averaging can help mitigate the impact of market fluctuations. By consistently investing a fixed amount of money at regular intervals, investors reduce the average buying price over time. This approach encourages buying more shares when prices are lower, which can be beneficial in the long run. The idea is to stay invested and take advantage of market volatility rather than succumbing to fear and selling when prices decline. By adopting a long-term perspective and conducting thorough research, investors can identify quality companies and find opportunities to invest at attractive prices. That's it for today's video, guys. If you like it, don't forget to hit that like button. Also, make sure to subscribe to our channel and turn on the notification bell so that you won't miss any future episodes. Thank you for joining us today, and we'll see you in the next video.